Let's talk about financing. You can't talk about financing without talking about acronyms. We've got USDA, VA, FHA, MHDC, LOL, RVM, CRM, SOI. I'm Brian Stone. Let's clear the air. So as I teased in the beginning, we're going to talk about financing. We're just going to talk about 4 of the many financing types that you actually have available to you when you're purchasing a home. If you're looking to buy a house, you're going to have some way of paying for it. And there's a lot of different types of financing. Unfortunately, they are not all created equal. Later on this week, I'm going to talk about how these financing types might impact you if you're in a multiple offer situation. But today, let's talk about some of the major differences. First off, conventional. This is the tried and true type of financing. Most people think you have to have 20% down to have a conventional loan. This is not true. You can actually do a conventional loan with as little as 3% at some banks or some credit unions. Also, 5% to 10% is a really common amount to put down. The major thing with conventional is there's fewer hoops to jump through. You don't actually have to go through as many requirements as you do with governmental loans, like what comes next. FHA is probably the most widely used governmental loan. FHA is a governmentally backed loan. The great thing about an FHA loan is you don't have to have a large down payment. You can actually have 3.5% down. That's typically the starting point. It means that you don't have to have a huge amount of money to get into a great house. One of the downsides of an FHA loan is PMI. PMI stands for private mortgage insurance. You're going to incur this on most all loan types if you don't have at least 20% equity in the home. It means that you're going to be paying a portion of your monthly payment to the bank to protect them in case you default on your loan. Unlike with a conventional loan, PMI doesn't go away. So that means you're going to be paying that fee for the lifetime of the loan. For most people, that could be $60 or $70 a month. Some people, it could be anywhere from $100 to $130 a month. It really just depends on your loan. Every lender is different. Another common loan type is USDA. People love USDA or rural development loans because they allow you to buy for no money down. Now, no money doesn't actually mean no money because you still have other expenses, but it's a big deal if you can get into a house without having to have that huge down payment. There are a lot of restrictions with USDA. Keep in mind that where your home sits widely impacts what type of loan you can actually get. The last type we're going to talk about is VA loans. This is a veteran's loan. This loan is for veteran, retired service members, or active duty members. There's a lot of requirements. You have to have approval from the Department of Veterans Affairs to actually utilize this loan. If you can do a VA loan, you really should. It's the creme de la creme of loans. You don't actually have personal mortgage insurance, PMI, with a VA loan, even though you can go as little as 0 down. A really cool thing about VA loans is they're also assumable. What that means is when you sell your house, if another veteran or veteran qualified buyer comes in, they can actually take on that loan from you. And that's a big deal as interest rates rise. If we're at 2.5%, 3% interest rates, and some point in the future you're looking to sell your VA loan home, rates could be 7 or 8%. That's a huge discount, and your house is the best house on the block. So we talked about a lot of different financing types, but there's a lot more that we haven't even discussed. If any of this stuff is intimidating, make sure that you reach out to a realtor or a lender to make sure that you feel comfortable. You want to make sure you're picking the best option for you. I'm Brian Stone with Keller Williams, and we've just cleared the air.